I think we're in a time and place where people need to start being more creative and not following the bandwagon. What we're experiencing right now is an environment where more times than ever, people are putting deals under contract and not making it over the finish line. I'm a big believer in creative financing as being a pivotal, part of how you get a deal done today. If somebody says no, listen and think about how could you be creative to get deals done.
I think to me, this is the year where sellers are really capitulating. Like they really are making a move and they can't just kick the can down the road anymore. So they're meeting the market and there's enough trades where you see that this is the new reality.
A lot of people want immediate yield day one, so going in high cash on cash, and they also want a strong per unit basis.
Discount to replacement costs and drawing cash on cash day one.
We're seeing a widespread deal flow that underwrites well.
There's a lot of seller fatigue right now.
Yeah.
From just being in this choppy environment, they need a surety over anything.
Be somebody who's easy to work with, be somebody who's honest, but also know your stuff.
All right, everyone. Welcome to another episode of Deal Flow Friday. I'm your host, David Mogavam, and today we got Michael Khalilzad, the founder of CastleSquare. Michael is super active, super on top of it. Michael and I have been working on a few deals, and he's always been super responsive, super helpful, super knowledgeable. You've also probably seen him on LinkedIn. I love your takes on the equity conversations you have, what equity is out there, what they're looking for. And I would love to bring some of that into here as well. So I'm looking forward to this conversation.
Well, I appreciate you having me, David. It means a lot. I'm not one to really go on public platforms. It's kind of funny. A few years ago, I did run a podcast, but I was on your side of the seat, and it's been a lot more comfortable. And the only reason I actually joined this today is just because of our personal relationship. I just think you're genuinely a great guy to work with, and um, I was excited to be a part of something that you're personally spearheading. So thank you for having me.
I appreciate that. And, for me, it's actually to have you on the pod who spoke to Sam Zell, to just have someone on the pod who spoke to him really elevates my pod. So selfishly, I'm happy you're on mine.
I appreciate that. That's funny.
And
I have so
I don't
many
know why
jokes about
you
that, by
haven't
the way.
started a pod.
I
Yeah,
don't know. I've
what's
been
that?
talking about it. People have been asking me as well to relaunch because they did enjoy the prior series. What we did was kind of unique, kind of going back to 2021 with that series. It was kind of fun. The whole genesis there was I wanted to try to inspire students in university to have a live conversation as well. So those podcasts that were publicized were actually live with college students sitting in the room
Wow.
where
Like a live stream.
yeah, because I thought that would give them a good opportunity to feel inspired to saying, wait, I just sat in the room with this type of executive. I feel like I could do anything, right? That
Yeah.
it kind of takes that separation of I'm just some young kid. How am I ever going to get to the top of the corporate ladder if that's the path they want to take? And now, I'm in the same room with them. Maybe anything's possible. It was just kind of meant to inspire young students, but also to educate or enlighten folks who are actually playing the everyday game, right?
And were they like interacting with
Yeah.
the speakers as well,
So
like live feed? That's pretty cool.
yeah, I have a joke for you only because you mentioned Zell. He was one of the folks we were grateful. I'm humbled that folks like that are willing to even join a platform that I was, a part of. Meant a lot. But anyway, I thought you'll get a kick out of this. So yeah, the format we did there was where we would run a proper, true, straight keynote panel, me and a speaker for about an hour. And then at the end of that, because that was the value proposition for everybody in the industry, at the end of that hour, then I'd open up the floor for students, professors, et cetera, to answer questions. And the thing that you just get a kick out of, I'm saying this. So one thing people learn about me right now is I like to be myself. I'm just a straight shooter. I talk to you like I'll talk to anybody, right?
That's
So
why I love
we'll
you.
just see where this goes. But anyway, so David, you'll get a kick out of this. When I did the Sam Zell podcast in particular, out of everyone we ever conducted, that had the most rules associated to it by his team. And
Makes sense.
one of the key rules is nobody is allowed to type in the chat. Nobody's allowed to interject. Nobody's allowed to ask any questions. Only Michael and Sam could speak. And it was a strict rule because for obvious reasons, they were a bit uncomfortable having a live audience and this being recorded. They wanted certain things vetted. And professors were trying to break the rules every 5 minutes, like screaming, I need to talk to this guy. And they were getting so ticked off, but they were such
They
good
just
people.
want acknowledgement from Sam Zell.
Yeah,
just like knowing that they exist.
It was funny, believe it or not. This isn't public information, but halfway through that podcast, because he's an inspiration for me as well. Let's be real. If he's not an inspiration to you, then you're not a real estate guy, right?
Exactly.
Halfway through that podcast, the fire alarm went off in my building.
Oh my God.
Yeah. So, but
I don't think I remember that. I watched the episode. I don't remember. Did you like edit it out?
Yeah. We cut it out, and I went downstairs and I say to the fire department, I said, "What's going on here?" Because I'm like, "Are you kidding me?"
I'm on the phone with Sam.
And you know what they said to me? "Oh, we're just doing a fire drill, so we have to come out for an hour." God. You know what I did? And they wouldn't know who it is, but I was so into the moment. I said, "Excuse me," and I'm not being cocky because I don't mean it. I'm just so into the moment. I said, "I'm on a Zoom call with Sam Zell. Please let me go back upstairs." And they shut the whole fire drill down. Said, "Oh my God, we're sorry." So I just thought that was kind of a
that is so funny. Oh my God.
Sound. I know. I forgot about that too.
Listen,
you just reminded me. But
luck
anyway.
wasn't in your favor, but that's why we have editing, and you cut everything out, and you're good to go. And the only thing I take out of that is, hey, amazing conversation that was, and you spoke to a legend.
I appreciate
so God rest his soul. And listen, back to business. Michael, I would love for the audience to hear what you're up to, what you're busy with. Again, one of the things that I really enjoy is on LinkedIn, you and Alana and your team, you guys post like, hey, I just had a conversation with this equity group and this is what they're looking for and this is what they're targeting. You guys also do a great job of saying, hey, I get a lot of deals sent to me from sponsors and they're underwriting like this. This is why that's not going to cut it. So give me a little bit of like, what are the type of products that you've been active with and sourcing and getting your clients capitalized for?
Yeah. So a few interesting things. One, I believe we're in an environment right now where it's more challenging than almost ever, at least in my shorter career than some folks with more gray hair. But in my career, it's been probably the most challenging time over the last 2+ years to get
100%.
to get deals capitalized. I don't know how certain sponsors are still hyperactive who don't have discretionary pre-committed funds. It is a tough environment. Although, yes, retail capital is probably a big part of that, and people have a loyal investor base, and it helps. But overall,
but retail is pretty tough too right now.
It's drying up big.
On all spectrums, it's tough.
It's drying up big for most sponsors. There are anomalies that I'm speaking about, right? When I mention retail, where there are some syndicators. It's an interesting word to be using as well after looking back over the past cycle. But some syndication platforms, they do still have very reliable capital. It's almost hard for me to believe. I've seen syndicators, primary experience in my day-to-day business. I've seen syndication platforms come in and capitalize common equity behind high octane preferred equity with a large amount of pref. And I said, that is insane. How
even
somebody has access.
like in the past couple of years, like even in this cycle, or are you talking about
in this current cycle, but this is rare. These are anomalies, right? So this isn't market themes. These are anomalies where I feel like it's either you're one of the few platforms who do have that reliable, still liquid investor base who is willing to back the deals you're doing, but that's definitely not a normalcy in this market, right? What we're experiencing right now is an environment where more times than ever, people are putting deals under contract and not making it over the finish line. That is becoming a common theme. It's tough for our team too, even where you may do everything somebody wants from you or needs from you. And then for some reason, they dropped the ball as well on their side, even a week before a closing table. So that yeah, it's tough to navigate. But anyway, with that being said, I I'm a big believer in creative financing um, as being a pivotal, part of how you get a deal done today. And one good example of that is we recently just signed up a $9,400,000 joint venture equity commitment for a deal in the Midwest. Contrarian play to the market, so I'm actually I surprised myself a little bit on this execution. To be real, it's a 1920s vintage townhome component plus a 1990s high-rise component in a more secondary slash maybe even tertiary market. That is not where common equity typically is flowing. That is a very, very contrarian strategy and request.
Hmm.
On that deal, the investor ended up formally saying no to us in the process. They liked everything about the deal, and the only complaint they had is, which they overlooked, they didn't realize it was easy to miss. Um, there was an HOA component because of a YMCA. But it made no impact to the operational efficiency. It was not a nuisance. It was just a fact of the matters. There's an HOA component here, but it made zero impact to the operational efficiency. And as a result, we believe it's not going to be too big of a deterrent for future buyers to create liquidity issues, because that was the main issue the investor had. Was Michael, our committee was ready to do this deal. We love it, but we have to pass purely because we have concern around exit liquidity given an HOA component. And instead of letting that deal die, I listened to their concern. And I got a little bit creative, and I just countered them. And I just said, hey, look, based on everything I've heard, based on our experience thus far, you guys love this deal. You love every single fact about this deal. You didn't have a single complaint, and you are comfortable with last dollar risk. Now you just have one minor concern about this HOA component and how it may pose, a challenge around liquidity. So what I did is I said, I want to do two things for you. I want you to meet with the investment sales broker who could tell you about how many buyers, including institutions, were looking at buying this asset in this immediate process, because that does prove liquidity. And then two, I'd like to propose something where you still do the equal amount of proceeds. It's still a traditional joint venture equity position from a equity ratio standpoint, from a pro rata cash flow standpoint, from a waterfall standpoint. But if you truly have a liquidity concern, we could directly help mitigate that a little bit by putting you in a second loss position. So the sponsors, it's not material. It's not like you're going to an 80% last dollar loan to cost like crap.
Right.
It's still a true equity ratio. You're not getting materially insulated. You're getting slight insulation where the sponsor's equity is first loss, and the sponsor is very comfortable with that, given how strong their basis was in this opportunity. And as a result, they came back into the deal. They said, Michael, I'm not saying I'm
Interesting.
smart, because this is not genius, but this investor who is sophisticated, they came back and said, Michael, to be honest with you, I've never thought of that. And that is genius. Let me go back. We'll meet with investment committee on Monday, and I'll give you an answer. But this could work. And it did. So that just shows you
Wow.
it's not a black and white market right now. If somebody says no, listen and think about how could you be creative to get deals done. And that is a really important factor in my career experience right now, to getting things over the
Yeah,
finish line.
so just unpacking that a bit, they were concerned about the liquidity on the back end, like how many buyers on the back end would buy this, and what you did to mitigate that is say, hey, by putting you in a second loss position, if you can't sell it or have to sell it for less, like you'll still be covered,
But
and
potentially,
maybe
right? It would help, right? It would help
yeah,
because you're not like
yeah,
dropping now your equity ratio to something more like pref equity, where you have a
right,
huge amount of insulation. But you were really comfortable at last dollar, so now I'm giving you a little bit even better basis, right?
yeah,
Just a minor, which yeah,
yeah.
yeah, exactly.
And it does feel like equity at this point, common equity like has the power, right? With how tight liquidity is and just the frustrations you were just talking about, how it's so hard to raise capital that when someone's kind of getting in bed with the deal, like, you know what, like this is a little uncomfortable, like they kind of have leverage in that regard.
Sure.
Um, have you been seeing that often, or is that this was kind of a one-off? Like,
Yeah, no, that's a good question. We're seeing a lot of different things. No, I wouldn't say that's a typical theme because some don't. A lot of a lot of a lot of investors don't want to so-called take advantage, right, of a sponsor,
of course, it's
given an
not the right way
illiquid
to be doing
market. That's
business.
not the right partner to have. That's not the right partnership to go into. So we're grateful to not experience people trying to take advantage of an illiquid market with the type of terms you're proposing. We rarely see it, which is a good thing. Um, what but what I'm seeing that is a bit interesting right now, and I'm working on navigating, is where I listen carefully to investor feedback, and then I think about pipeline, right? As a result, where do we want to spend time? What could get across the finish line? But like, for example, what we're seeing right now is a really common theme with investors is a lot of people want immediate yield day one, so going in high
Hmm.
cash on cash, and they also want a strong per unit basis. They don't want to overpay for immediate cash on cash. They want high
Discount to
yield.
replacement costs and strong cash on cash day one.
Yes, those are two massive things. And what's really interesting, though, so we just ran a deal in Western US. I love the opportunity, to be honest. It was a 7.1 year one cash on cash. The building was built in the 1990s. Sponsor has experience in the local market. Good story. But not every, some people, we did have an investor step up who wanted to put in common equity. It was a RIA who's done 57 investments to date. They loved the opportunity. But not everybody did feel the same way about that basis. They felt like the basis was a little bit too expensive for that immediate cash flow. So it was interesting. Shortly after, we ended up getting a really strong pipeline that fits these themes of what everybody wants to write a check for. Very good discount on a per unit basis standpoint and strong immediate yield. And right now
And
we
what's
have
strong? Sorry to cut you off. What's like a strong yield when you say that?
6%
Is
year
that
one
like,
cash on cash, depending on
yep,
vintage. If it's like an A-class property, core location, somebody would love to take a 5% cash on cash going in. That's a
sure,
great coupon, right? But if you're buying a bit
sure.
of an older property, maybe more secondary market, you want to be
You
closer to
want a
like a
six.
6+. If yeah. And we're seeing that, by the way. Last year I didn't see much of that. That was a really high bar where it was almost awkward to tell clients that that is what we want to see, to be excited to try to help procure
But enough
equity.
people have said it now, where now
Yeah,
it's you're starting to see the market correct, and then you're also starting
yeah,
to see, at least on agency, you'll spreads start to come in a little bit, where you can do a buy down and kind of get there with
yeah.
some financial engineering.
Yeah, what's really interesting right now is we have exclusive mandates on a handful of opportunities that all mimic these type of returns or deal metrics. We have a deal right now that we're extremely excited about. Love the client. He's bought 25 assets to date, full cycle 13. He's really active. He just had a deal in Salt Lake City spoken for with an equity partner in the closing process. He just had a deal in Ohio spoken for. We were a part of that, gratefully, spoken for. And now he has a third opportunity that we are drooling over at our firm. Um, from every single factor about this opportunity, where he is under contract formally to buy this at a per unit basis that's 27.8% lower than every single relevant trade in the market. That is a phenomenal basis. His year one cash
Post
on
rate
cash.
hike,
What did you say?
like post rate hike,
Yeah,
or
no,
you're
right
saying,
now
yeah,
this is
yeah,
live. Yeah,
yeah,
right now his
discounted
pretty.
market today.
Yeah. Oh, yeah. Sorry.
Yeah,
Yeah. So like
yeah,
there was a trade end of March of this calendar year that was 30,000 plus per unit more than what he's buying it for, and that was of an older vintage. So he's truly buying based on relevant recent trades, almost a 30% discount on a per unit basis. If you go and speak with local developers, he's buying at a 35% discount to replacement cost. If you look at his immediate year one going in cash on cash, conservatively speaking, it is well past the 6%. And it's a
yeah.
privilege to be a part of that opportunity because it's 1990s vintage. That's new enough for a lot of the market to like. That's a liquid enough, you know,
North of a six
yeah.
cap, I'm assuming, right? If you're
Yes,
getting to
it's
that
it's
cash
it's
on
a
cash.
6.35 using agency NOI.
Yep,
It's not
yep,
bad. It's good metrics. So we feel
yeah,
great
and
about this
yeah.
one. But you know what's
That
funny,
and
David? We haven't
what
seen
area
any
you
of the
said?
go ahead.
What
1990s.
Or what area? Sorry.
Oh, it's in the Midwest.
Yeah, so one of my previous pods, someone brought up the analogy of like a Kool-Aid, and he brought a
Yeah.
6-pack of Kool-Aid because of a 6 cap, and he brought a Kool-Aid pack that was made in the 90s because the 90s in newer. And
Yeah.
he's like, I'm drinking the Kool-Aid, 6 cap 90s and newer. He's like,
Yeah.
and we're finding these in the Midwest.
Yeah,
And
it
he brought
feels
out a
good.
corn.
Yeah, yeah, it feels good.
And
They think that they like what I'm talking about, by the way.
yeah,
It's a good play. Just it's a big deal though. But the
right.
fundamentals are there. That was a funny podcast, by the way. I teased him about it,
Yeah. Yeah.
jokingly. But you know what's crazy, David? So it wasn't too common to see a lot of this last year for me, at least based on our pipeline, right?
It was tough. It was
Yeah,
tough for sure.
right.
I
But
mean,
now,
especially in the Sun Belt, with if you wanted like a true 6 cap was very tough to find in the Sun Belt with supply glut, concessions. You started seeing some bad debt, and then we own a lot in Colorado. You started to see some operational challenges in the coastal markets. You didn't see it yet, so I think a lot of people flock to the Midwest because you can buy kind of better vintage 6 caps, and there's a lot of diamonds in the rough. I think you were about to go say right now it's starting to become more common because why? I think to me, this is the year where sellers are really capitulating. Like they really are making a move and they can't just kick the can down the road anymore. So they're
yeah.
meeting the market and there's enough trades where you see that this is the new reality.
For sure. It's the first time I could say this in a long time where we have a very full pipeline of live exclusives where these deals all meet these type of requirements, right? Where I feel very good about saying I will get common equity across the finish line. We have a deal right now in East Dallas. If you know East Dallas, the sponsor has an asset under contract at 89,000 per unit. His all-in cost
Wow,
basis
what
is
what vintage?
103. It's a little older. It's 1980s, but Class B real estate. It's a good-looking asset.
Hmm.
He has this under contract at 89,000 per unit. His cost basis is 103,000 per unit. If you analyze the sales comps in the neighborhood, the only thing that's ever sold even recently for 103,000 was a fire sale of a guy in distress. Everything else is
Yeah.
selling 120s and up. So we feel
Yeah.
good about that basis. It's well over a 7 stabilized yield on cost. It's a good story. So we're really excited with a lot of what we're seeing. We have another deal in tougher market. Okay, let's be real because of tenant and landlord laws. The tenant laws are making it a bit tough for equity. So we don't love the market, but we love this local sponsor and this basis play as well. They have an asset under contract in a phenomenal neighborhood of Washington, D.C. They're buying this thing at a per unit purchase price, well over 6 figure, like 100+ thousand below where other comparable vintages have traded recently. It is a phenomenal discount. Their year one
Yep.
cash on cash skyrockets above a 6, and they're also taking advantage, which I really love, of it of an accretive seller pref. It's not high leverage. It's only 8% coupon
It's a
with a
seller
5
carry to kind of bridge the gap to get the pricing that they need to get to.
it wasn't, yeah, it was just a tool to make the returns even more juicy without having some high octane piece of pref because JV equity doesn't sit behind pref.
For sure.
Doesn't sit behind pref. But guess
But they'll
what?
sit behind a seller carry, yeah,
They're comfortable
that's
with
in the
that.
market.
This is super soft, super friendly. It's 8% all in with the 565 current. It's great. So this deal is pushing it north of a 20%. It's a net 19 IRR. That's not that easy to find. So it's like
For sure.
we're seeing a widespread deal flow that underwrites wells. That's the whole point. That's why I'm so excited right now. It's just
Yeah, Michael, let
it's
me let
ramping
me
up.
ask you on, you have some great clients and some great repeat clients, and it sounds like they're finding some really solid deals. If I talk to most sponsors, I think sometimes that's probably not as common as maybe you're seeing on your pipeline, right? Because you get all the good deals to get capitalized. How do you think these sponsors are sourcing deals? Or you don't need to give up their secret sauce, but
Sure.
what are some common themes that you're seeing that the story that you're hearing from the story that's getting to where it is? All these good
Sure.
deals have to have a story. So what are the stories you're hearing?
Sure. So one story on a deal we're doing right now. The sponsor has a so this isn't the founder of the firm. They're looking to grow their presence in a certain pocket of the country, and they hired a great boots on the ground team. So highly experienced
Mm-hmm.
guys with a great local reputation. There's an opportunity right now that they're under contract in where the seller's a bit just like not literally distressed financially, but distressed because she just went through a process with an alternative buyer who dragged this thing along for so long, so much diligence, took so much of her time, and they failed to close. And it was a lot on her mentally. Like this is really actually drained her. She did not want to go through this process again. So she put it back on the market. It was not fully on market, but they talked to key people, and our client was awarded the deal for millions of dollars below the next buyer in line, millions of dollars below, because their reputation, this guy in the local market, his reputation is phenomenal with the brokers, with the seller. They knew they were not going to cause headaches. They knew they're good for their word. They're going to close this deal and they can move quick. And that got them a substantial discount because she didn't want to go through another stressful process. Um,
Yeah.
yeah. Um,
By the way, that's a story that is definitely a common theme. It's not an anomaly. Like there's a lot of seller fatigue right now
yeah.
from just being in this choppy environment, and sellers that need to make a move for liquidity purposes are in a bind. They need a surety over anything. Like price, obviously people want to get the highest price, but at some point you just got to say I need to go for the sure bet. And I
Sure.
think you're starting to see that. And so reputation, staying around the rim. I've said this before. I think the broken sale processes, you're starting to see a lot of good value where you're not the highest bidder, but they go for you because of reputation and
Sure.
just the process playing out.
Sure.
I would say a couple years ago when people were having low maturities, you still had a little bit of, I guess, outlook that things are going to get much better later on. So they would say, okay, let's wait another year. Let's buy another rate cap. Let's do our capital call. I think we're at a time now where the capital calls are over. Um,
Sure.
if you haven't done a capital call up until now, then your time is up.
Sure.
And and lenders are also kind of agreeing that things aren't going to change much from where they are today. So I
Sure.
think the motivation, like you're saying, is actually now starting to translate to sales more
Sure.
than we've ever seen it.
Could I semi pivot the topic for a sec because you mentioned
Sure.
capital call and it just reminded me of something that I would love the opportunity to take advantage of this time together on a live podcast to just
Yep.
throw something at the audience. Uh,
Yep.
People learn a lot about my personality quick. I am very opinionated, but I'm a good guy, but I love to say crazy stuff, right? Because that's how people learn, right? It makes my
Yeah.
team laugh. People love when I say something insane because then they just think it's funny. I say it as it is. If you're watching this podcast and you're new to the business and you have a property under contract where you're assuming a floating rate loan, and you tell me or any investor that you're very good at finding good deals, but to make it pencil, you leave key things out of your budget, such as funding a rate cap for the entire life of your hold period, you're not good at finding deals because it doesn't pencil. And you should not be buying a deal with investor capital where you don't have
Hey, man.
something like a rate cap fully funded for the life of your investment period because you're a fiduciary to your LPs and that's inappropriate. So
You've it feels like you shouldn't have to say that, but with some of the bad buys that you've seen and just the people out there,
no, no,
you
David,
got to
it's
say
not
it.
the bad
You,
buys. I see
yeah.
stupidity where people are buying tomorrow who haven't learned from the bad buys. And
Yeah, it's
I'm like,
crazy.
are you kidding me?
Crazy. It's crazy.
And
You
I swear I
Michael,
say it because David, it's crazy.
you probably see some pretty bad underwritings. I could tell.
It's
Like you have some good
crazy
clients, but then you probably have some people that are just coming out of the woodwork and saying, "Hey, I'm under contract. I'm hard. I
for
close in
sure.
20 days. I need capital." And then they're like, "Well, no wonder why you haven't raised capital. Look at how you underwrote this deal."
For sure. But you
So,
know what's
how do you
really
vet that?
concerning to me
How
though?
do you vet that? Let
Yeah,
me just ask you, how do you vet that in the beginning? Like how do you vet the guys who are for real versus the guys who just need to get some capital quick and might get wiped?
To be honest, I don't believe in speculation because I'm conservative. We worked on launching a bucket of capital back in quarter 1, where we were looking to deploy 900 million into ground up development projects, and that changed my whole philosophy as an intermediary for advisory side of the business on how to analyze a deal. And when we launched this program that we were looking at doing back in January, we had a ground lease component. And then we would pair that with a non-recourse construction loan. The reason we did it is for a few things, right? If we go back to Sam Zell's podcast with us, right? One thing he said is, to make real wealth, you need to have a monopoly. You need to be contrarian. You don't want to jump on the bandwagon. Why would I want to be a prep allocator? The whole country's allocating prep. I'd rather try to do what nobody's doing. And I
Right.
understand why nobody's doing senior debt behind ground leases, right? It's a very challenging thing. There's a lot of risk associated to it, but we think there's actually a lot of benefits. So anyway, when we worked on launching that program to put out 900 with a REIT and a conglomerate, I had to really start thinking a lot more conservatively as well, because brokers could be aggressive, right? And just trying to push, push, push. So when we did that, because of the ground lease component, I built a higher level of discipline, because if I have a conglomerate partnered with me to go allocate construction financing where we're originating a ground lease alongside our product, business plans need to go according to plan because of the elevated risk of being on a ground lease. If something
Right.
doesn't go according to plan, you're in a very scary position. So, with all that being said, I don't like to believe in speculation when I evaluate a deal. And most investors don't like to do that either. So if a sponsor's never done something, for example, that's not a very good story to me. If it's a new business plan for a sponsor, how do I get comfortable? Okay, if you're, and I'm not just going to shut you down. It's let my job is to help be valuable to you. Let me try to help come up with a story here that actually is credible, that we're comfortable with, and see if we could do something. So when we think about sponsorship, ideally the best story that people want to see is a sponsor who has at entity level has done what they're looking at doing again. But if that story is not there, we're definitely going to want to analyze a sponsor's prior track record, who's on the team, what is their actual involvement, what is their skin in the game, how much money is coming out of your pocket, what are you netting in this deal after fees in terms of skin in the game. We look at all that. If a sponsor says he's done a bunch of things, great. Well, let's analyze that SREO. Make sure his portfolio's not in shambles. If he has one deal that went bad, I want to talk to him about it, and I want to hear how he responds. Is he an honest guy?
That's key.
You want
I would say that's even more
critical.
key, right? Like how are you handling these deals like in out of this cycle? Because
A
if
hundred
someone's
percent.
been in them, if someone's been in the game for they started their company 10 years ago, they had a 7-8 year bull run,
A
right?
hundred
So
percent.
so
Yeah, how are
you
you
you know
performing when
in
shit
this
hit the
cycle.
fan, right? When
Exactly.
everybody was in when not everyone when it, you could almost say that metaphorically, when everybody was was struggling a bit, right? What did you do to navigate that market, right? And it's not just about how they navigate, though. I'm also curious as to your character. What are you going to tell me about those tough times and about your portfolio, right? Are you an honest partner, or do I think you're not being transparent? So it's a holistic approach is the point, right?
Mhm.
On how we think about
Right.
sponsorship. But the theme here is we don't want to speculate.
One thing, like, I know you're talking about ground up. It's tough to make ground up pencil right now in general because unless you're in markets that are super supply insulated
Sure.
and you're still seeing rent growth, like maybe parts in the Northeast or like just different supply
Yeah.
constrained areas, it's really hard to make these type of construction costs, borrowing costs, basis
Sure.
pencil when you can buy below replacement cost. So like how are you making those, because I know you were saying like you were putting out some ground up construction money.
Yeah.
How are you making that pencil? And I think you were saying offline maybe that you guys were pivoting strategies or coming up with something.
Yeah.
So I'd love to hear a little bit about
Yeah,
that.
for sure. Believe it or not, I love the ground up business, and it's just tough. It's tough to make work right now. But Where I think I'm the biggest nerd is definitely when somebody says, "Could you look at my ground up deal?" I always smile knowing I'm about to look at the Excel sheet
Yeah,
out of
but the ground up
curiosity.
developers don't know how to underwrite usually. I think,
Yeah,
like they're usually to be a ground up developer, you got to have balls. Like
sure,
you
sure,
gotta, and like if there's a joke that like ground up developers, if you haven't filed for bankruptcy, you're not a real developer. Like that's like
sure,
the joke because there's so much risk. There's no cash flow. Your first
sure,
dollar is when you finish lease up, and then you have to flip out of it. It's very tough. Like I'm not
sure.
talking about like the related groups and like
Sure.
the
You know what?
the
You know what I
the
think is actually
institutional ones,
really
but
insane when it comes to being a developer too. In certain cities, depending on what you're doing, having these assemblages. I've seen crazy things from smaller guys who are in almost over their head to get their deal to actually get a shovel in the ground. Just getting through the assemblage of all these parcels, depending how the type of project profile or location, the carrying costs, the pre-development process, and they sweat. It's like it's been a year, it's been 2 years. It's 3 years in some markets, four, right? And that to me is also pretty crazy when it comes to the grit you have
yeah.
to have as a developer. It's nuts, right? What we're trying to do though, right now to help smaller developers, right? Smaller players is bring in a joint venture partner who is actually a blue chip developer, one of the largest in the United States of America. We have a phenomenal relationship with them, one of the largest affordable housing developers in the US. They've been around for countless decades, but they're also active in other resi food groups, right? So traditional market rate, student. They're comfortable as long as there's not entitlement risks. I will say that, but they are comfortable buying
Mhm.
land and going through.
Shovel ready.
Yeah, it could be. It could even be a little bit ahead of shovel ready, but there's no like call it
But by
juris
right.
like zone. Yeah, yeah, exactly. And what we're essentially doing for smaller sponsors now, we actually are in the middle of one right now, is bringing this blue chip developer to come in and partner with a small little developer, and they'll fund 75% of the GP equity in the deal. In this case, the GPs want a promote, meaning they're not putting in all the LP equity, right? But there's
Hmm.
still value
Hmm.
here, and I'm going to get to it, right?
Yeah. So
So,
like if on like the equity side, let's just dumb it down.
sure,
Let's say you're gonna go vertical. The construction loan is 60% LTC. The other
sure,
40% is equity, and then the GP is gonna be probably 10 to 20% of
correct,
that 40, right?
correct.
And then what you're saying is they're coming in for 75% of that 20.
What's really exciting about this is that not only will they contribute 75% of that capital, they're going to sign any loan guarantees, meaning that's essentially unlocking financing you probably wouldn't have had access to without that guarantee, without those guarantees and that partner. So now you get way more accretive financing, way more accretive financing. You now have a balance sheet that you could do these bigger deals that you wouldn't have had without that partner, right? And not only that, now you also unlock equity because they're truly a development partner. They're a co-development partner. They'll let you do whatever you want to do that you're good at. They're comfortable with you doing GC work if that's what you're good at. They're comfortable with you doing whatever you're good at. They're not here to step on your toes. They're true partners, but they are a code developer, and that unlocks the equity as well because it's so tough right now. If you're the biggest developer in the country and you're a code developer in this project, I probably will have a easier time bringing in a joint venture equity partner, and we work really well with them. They're a capital markets team. We could collaborate. They could help bring in a joint venture equity partner. So I think that's a really good tool that we're using now to unlock capital stacks for development projects in this tougher environment because we do hear this theme. There's a fund in New York City. They were founded by former Carlyle executives. They manage $250 million. They're only targeting maybe four MSAs: Atlanta, Boston, and two others, right? I think Seattle. And we have a live deal right now. And they said, Michael, I love the project, but this developer's an in-house GC, and he's only done a few smaller deals. I won't touch this with a 9-foot pole purely because of that. So now
Mhm.
by bringing this one partner in, overnight interest, right? So
And
we
then
see a lot of
this
value
other
there.
partner, they get to leverage their experience and their liquidity in a market where look where capital is only getting placed to few and far in between experienced sponsors. And you're solving the capital dislocation that you're seeing right now.
Yeah,
Where by doing a co-GP, you're giving that capital solution to those people who are in a bind, don't have the liquidity to, sign the liquidity requirements on a loan or
yeah,
meet the net worth test because they're just it's a tough market. Why would you sell in this market? So the deals
yeah.
that they were supposed to flip out 3 years ago, now they have to flip out 6 years from now, you know?
Yeah. Yeah. No, 100%. We actually enjoy we really enjoy playing in the whole credit enhancement space as well. We really enjoy credit enhancement executions because at least in our experience, maybe others watching have a different experience and they find it to be more liquid. But I personally, David, find credit enhancement, getting a loan guarantor who is maybe doesn't know you that well as a sponsor isn't that easy. It's not that readily available to have somebody come sign on your loan docs. And we
There's
do
more
have a
strings attached
yeah,
to it now. Yeah.
yeah, and we have a very reliable solution there, where within maybe 48, within maybe 2 to 3 business days, worst case a week, we could turn around and almost guarantee have $100+ million net worth and $15+ million liquidity readily available to come and sign on your loans. Non-recourse, but yeah, to come in, sign on your loans,
Yeah.
even if it's
Yeah.
whether it's grant up
Non-recourse.
development. Yeah,
Exactly.
that's key. Even if it's grant up development or acquisition or recap. So we're doing a lot of that right now. A lot of lenders came to us saying we should partner up where we could bring you all of our borrowers because we really have a frictionless process. You're not going to have to wait 2 weeks and I'll figure it out. Oh, no, no. Like many times I'm figuring out in 24 hours. It's like programmatic. It's just sure with
Yeah.
the right deals. So that's been a really fun place to play given for us, it's pretty fluid. It's a very liquid. We could keep doing it for the right deals, right sponsors, move fast. It's reliable and it's valuable, right? I'm seeing a lot of deals in limbo because smaller players, right? They don't have that, and everything else is spoken for, and we could come in and they could close. So it's a good feeling. We're doing a few of
Yeah.
those right now as we speak.
Yeah. And I think, you guys serve really well in that space. It seems like where the middle market, emerging operators, maybe or proven, like also. But
Oh,
what I'm
totally.
saying is like those people need people like you, and
Oh,
it seems like you've had a lot of success with operators like that. I guess to some closing thoughts. These emerging operators, they're trying to raise capital and they're trying to put deals under contract and get them closed. What's like some general advice you would give them? I know you gave some passionate advice already in the middle of the pod of
I was just
underwriting and things
being
like that,
funny.
but what's like some general advice you could give like an emerging operator right now looking to raise capital? Um, and then on the other side, and I'll let you start with that, but on the other side, it's also what's some general advice you would give capital because you're matching the two together and marrying the two. So
Sure.
what's some advice you could give to both sides to kind of hear what you have to say?
Sure. When it comes to sponsor advice, I think transparency is key. Be somebody who is easy to work with, be somebody who's honest, but also know your stuff, right? Don't send somebody like I'm. It sounds it's common sense, but I see so much business, and I when I say things that seem like common sense, I'm speaking because I see so much crazy things from sponsors. Know your stuff. Don't speculate in your underwriting. If you're showing somebody a business plan where you're like I did there's one thing that I'm comfortable saying this example out loud because I did directly tell the sponsor my opinion a few days ago. But if your business plan is literally based on interest rate movement, cap rate movement, like that's bullshit, right? You need to be able to find deals with good fundamentals. Focus on opportunities where you have healthy immediate yield. You want to buy assets with a 6% year one cash on cash. If you're going old pre 2000s, maybe if you're buying newer properties, core markets, great locations, a real class A lot, five's fine, right? But if your business plan, this is a really good piece of advice, honestly, for all sponsors watching who are smaller at least. If you're trying to buy an asset where your year one cash on cash is well below like a 5%, and it's like a 1980s, 1990s property, and your asset that you're under contract to buy is like 90, it's stabilized, and your business plan is to just push rents, that is a very tough story right now. It is
Yeah.
extremely contrarian to equity. And that is, if I would as a sponsor want to align with where there's the largest box of interest from investors to have the highest probability of getting a deal over the finish line. I've done deals gratefully that are contrarian. 1920s vintage, population of 50,000, the Boondocks, right? There was a deal where the median household income within like a small radius of this asset was $21,000. We were just joking back and forth, and they couldn't breathe laughing. Saying, "This is the first time I think in my career I underwrote a deal with this type of median household income." I mean, it
Yeah,
gets
it's low.
crazy, right? But
That's low.
so like people don't want to do these type of deals. That is an illiquid transaction profile. I'm not telling you don't pursue if you think there's a good opportunity. I have contrary investors. I've done it, but that's just you're not aligning with the theme of the market. So your probability of just closing transactions go down if you don't know who those anomalies are, right? We
Right.
only take an anomaly transaction because we know exactly who's doing that, that contrarian play, and it's fairly black and white for those folks. And then as it relates to the capital market side of things, I think we're in a time and place where people need to start being more creative and not following the bandwagon. I have a lot of opinions here, but I'll keep it short. But this is a very I really would like to see more innovative products in the market. When you look at preferred equity, everybody's offering, right, their current pay, their accrual, whatever, all this crap. That makes it very tough for sponsors to raise equity. So that doesn't feel that liquid to me. How are you putting out all these dollars if you're issuing a product where sponsors can't raise common equity? That's tough,
Behind it, you're
right?
saying like
Yeah,
why?
it's tough. And
Yeah.
you're not speaking for all the equity, and you're giving a product that makes it almost impossible for sponsors to fill the gap. So
Yeah, it's like we'll
that's not
get
that
to
accretive to
80%
me.
last dollar. How are you going to get the other
Yeah,
20?
20%
Right.
of $50 million for a small sponsor, you like it's not easy. And
It's not
how are you
easy.
going to raise the money, right? So we have a lot of thoughts on how to have just better financing options. What I personally would love to see from more investors out there is a solution where it's a bit of a hybrid, right? Because you could even be disciplined about the transaction profile where you feel like you're getting all the benefits of preferred equity, but it's really a hybrid of pref and JV. And but again, only doing it on deals maybe where you feel like you're again getting some of the perks of a pref position. So what I would love to see from a lot more investors is where you have a second loss position, joint venture equity investment, where maybe you're not 90-10 JV equity because that's not a lot of insulation. Maybe you're 80-20 JV equity. So you said still a fair equity ratio. You have a little bit of, right, not a huge, but a little bit of insulation, right, relative to your last dollar exposure, because the common equity will be lost before yours if there was impairment. But but on cash flow, you're pro rata. So now all common equity is happy with the deal based on cash flow. There's no accrual because accrual creates risk. If the business plan goes a little bit sideways and this accrual's adding up, you're really going to damage the common equity. Sophisticated retail investors don't want to sit behind this, right?
Yes.
So this hybrid product where you're a second loss joint venture equity investor, pro rata on cash flow, no accrual, there's no current pay, just pro rata. At sale, you're insulated by whatever your equity ratio is. Your principal's paid back first. Any common behind you is paid back second. And then there's a waterfall. That to me seems like a much better product that will be more liquid. A lot of people could close the gaps behind that. It's a lot safer for the sponsor. And it's honestly a good product as an allocator because if you're selective about deals you do this in, you could have an immediate yield day one. I have a pipeline that's so robust. I can't keep up, honestly, David, with all these deals that have a 6% plus year one cash on cash. The amount of preferred equity investors who say, I could do a 6% current pay. Well, guess what? You could get a 6% yield without business plan risk if you're just selective. There's countless opportunities to get a 6 or 7, call it a 6% plus yield. That is your current pay, right? So I
Yeah.
like that story. I have a robust pipeline where people are buying at a huge discount to replacement costs and to recent trades. So if you're a pref product and you're saying 80% LTC, well, 80% LTC on an expensive deal is the same basis, in my opinion, as an 80-20 equity ratio if somebody's buying 30,000 per unit lower on a
Yeah.
cost basis than everybody else.
Yeah.
So that's what I'm thinking. That's what I'd love to see in the equity market. I want to see more innovative products. I don't want to see everybody copying all other. Get off the bandwagons. We need more innovators in this space. That's how deals are going to get done. And I look forward to kind of seeing what's out there, over the coming months.
Michael, I think that second point about capital is super important, right? Like I went to NMHC and every institution and their mother is saying, we have this pref product, we have pref product. Like we're not putting out common, but I have pref. And on paper, it might seem fair or might seem even safer. But as you said, like 80% of something that's overpriced, even
It's
like
the same
rescue
stuff.
capital,
It's
it's the
relative.
same stuff and not as liquid as you said. Like who's going to get behind that? No one's going to get behind
100%.
that. Even on rescue capital, the only way you can truly get pref to rescue a deal in this time is if you're probably resetting the basis. So
100%.
at that point, why don't you just do what you said and just come in as common with maybe a little bit of a mitigate in risk, like a second loss? I think that's a great
You
idea.
know what's
And
funny, David? I know it's over now, right? We're wrapping up. We're literally
yeah,
testing this thesis right now, meaning we're challenging a Blackstone subsidiary company that we love working with them. If people don't know them, these are class act guys, but they've pivoted away from joint venture equity to preferred equity. But I just sent a very detailed analysis as to why, in my personal opinion, and I laid out this creative structure, is far more accretive on this deal than if you did a preferred equity, the standard preferred equity on your typical deal, right? So yeah, we'll see. It's something I'm really passionate about. Is all. I feel like there's a big need for this right now. So
yeah.
anyway,
Well, Michael, it was amazing having you on. This was a great time. Every time I talk to you, it's always a great time. You're
likewise.
passionate, you're on the ball, you're just running 100 miles an hour. Your thoughts are all over the place. And when you bring it all together and pitch these products and get operators and equity to come together and marry them into a deal, it's a beautiful thing, and it's even tougher in this environment. But you do such a good job doing it. So thanks again for hopping on, and looking forward to discussing more deals together.
Yeah, I appreciate it, David. Thanks for having me.